Real pleasure to bring on board a very dear friend of mine, Bala, Managing Director and CEO of Aditya Birla Sun Life AMC, and to discuss markets and to discuss how things are moving, at least on the domestic inflow front. Bala, fantastic to have you back. Exactly a month ago, nobody was focusing on positives. Now we're ignoring negatives.
Because we didn't have positives.
Valuations were not bad. Valuation was the positive part,
Yeah.
Aisha. So what is the right market? The one we saw in June, exactly a month ago when markets bottomed out on 17th of June, or the market we are reporting right now? Because it's like a mirror image.
Yeah, I think, first of all, good morning, Nikunj, and nice to be part of your show again. I think last few months have been tough for the global economy. There is no doubt on that. Second is the way I think the policymakers change their course from a gradual hike to a sharp rate hike, and then the sudden spike in oil prices. All of them actually led to a sell-off from global market purely on the basis of the asset allocation model. The global investors have been overweight on emerging market, and US hedge funds have been struggling to make money. And huge crash that we have witnessed in Nasdaq, especially in the companies where the valuations had gone through the roof, they all got corrected quite significantly because money was moving out of equity market to either the bond market to some extent, or the huge amount of laws have also forced some of these hedge funds in US, there are small boutique firms also had to be closed down. And then uncertainty continued. And therefore, the challenge that we saw, despite the valuation came to an attractive level, the challenge that we saw in the market, largely on account of many unknowns were in the market, and the only way one can deal with that is to using the asset allocation model. That's the way I think FIs have been the continuous seller in India. Even today they have been a seller. But I would assume sometimes the market gets sold off quite significantly, and that's what we have seen. And
Did that happen in June? Do you think we sold off much more than we deserve to be hammered? Because even though when markets fell in the month of May and June, everybody came out and said, okay, you become cheap, but you are still trading above historical valuations.
Yeah.
So if market valuations were here, and this is the average, after the sell-off also we were here.
Correct.
So the market was not cheap even. So then why the bounce back has happened?
I think one is the market always got two type of behaviors. One, for any unknown that comes and hits you, the market gets sold off immediately. I think nobody even cares for the valuations. Nobody cares for how I think
Just sell and go.
They just sell and go.
Yeah.
I think that we normally will see it every time when the market becomes a bit uncertain and the views becomes uncertain. And what we have seen actually is that in that direction. Second is the growth expectations also keep changing. And the growth expectation what was there last year when the interest rates are low, and the growth expectations today when the interest rates are rising is again completely different. Therefore, market valuation has to get adjusted. And third is actually another way to look at is the earnings yields versus the bond yields. From a broader perspective, the companies continues to earn so much of profit.
Okay.
At the same time, it's not sufficient enough to give a higher valuation because then your cost of capital also is rising. So then one has to look at from that context as well. Therefore, the market gets sold off because it always remains unprepared for some of these unknowns that could come and hit the market. And the way we saw actually the corrections coming in commodity prices globally, the way the government started reacting after Reserve Bank of India hiked the first interest rates. First, Reserve Bank of India did not hike the interest rate in the policy meeting. Then the interim meeting they called for it and hiked the interest rates. That set the ball rolling. India is going to actually hike the interest rates as we have seen in the US market. The inflation is real, one cannot ignore. And even if it comes the cost of the growth at this point of time, but inflation control actually became a priority. Priority, of course, keep changing from government point of view. And India is the only country, including Reserve Bank of India governor, they maintain a balanced approach, maintaining growth on the other side, at the same time controlling inflation on the other side. I think they're trying to marry these two things and ensure that we actually able to at least get a balanced growth. Whereas the US did not bother about the growth. I think US clearly bother about only
Inflation.
the inflation. Therefore, when the target changes, priority changes, then the market allocations or rather the sell-off that we have seen normally tend to happen, and valuation of course taken to a certain level it becomes a buy. Therefore, I would assume some of the steps which the government of India is taking very recently, for example, just rollback of the gasoline taxes, just about 15 days back it was introduced. Now they are rolled back. Either they are drawing comfort that yes, this will not have much impact on inflation, therefore we have to let this go. At the same time, taxing some of these GST related items, they have now increased the breadth.
Yeah.
There are certain cases of increase from 12% 18%. There are certain cases they've introduced a 5% minimum tax, minimum GST. Therefore, the government is also taking some steps actually ensuring that one side we ensure the tax collection becomes better, other side inflation actually keep a close watch and ensure, take all the steps necessary actually keep the inflation under
Cheese,
control.
paneer, milk, everything's expensive, Bala.
Exactly.
That's
I'm
why
not
you put
happy.
dairy.
Exactly. So
Now, look at this way, Nikon.
I was always been told that be vegan. Now I realize
There's reason.
the reason
There's
why
merit
that
in doing
being
that.
vegan.
But you know, Bala, the interesting thing which has happened from last month to now is there is a sectoral shift. Look what's happening on the screen right now. Autos are outperforming like never before.
Correct.
And IT is underperforming. FMCG maybe is now going to go into consolidation. So what is it that you're making of the sectoral shift? Do you now need to place your bets on different kind of horses?
See, one of the things that normally happens is the overweight and underweight exposure, which one takes in any sectors. Like auto as a sector has got the least representation in the index.
Exactly.
And IT as a sector has got almost 14% weightage in the index. And most of the managers would be actually either neutral weight or
Those are your
higher weight.
managers.
Yes, including our managers. And second is when the NASDAQ falls quite significantly, the NASDAQ generally is considered the proxy to the IT as a sector. Whereas in real sense, it's not necessary. The Indian IT companies
Are very different than
very different from NASDAQ companies. But the asset allocation model changes, naturally it gets sold off. That's something we have seen this, especially time
out, yeah.
when rupee dollar touching 80. Ideally speaking, export-driven companies should be the largest beneficiary, including IT companies, and they're all gone by the guidance which they're given for the quarter ending. So that's something which I think driven that. But auto as a sectors, I think if you now look at the ground reality, I think the fortune of auto companies are now beginning to change, especially in two-wheeler has gone through 2.5 years of tough time. Now we are seeing actually the revival in the buyer's behavior. Passenger vehicle, now we are seeing a revival behavior. There are certain cars which has been introduced by some of the auto companies. There is a waiting period of 1 year. So all those things, what does it mean? They're all now early indication that the sector which has underperformed for a very long period of time, there is high probability some revival could come in that. And most of the companies, unlike the past about 2.5-3 years back, they're all now looking a little progressive in terms of looking at EV as part of the business as model itself, rather than ignoring EV is something which I will not be able to get into that. Every company today is actually making an attempt to ensure that they become actually EV oriented company in some form or other. These are all progressive in nature, therefore some element of interest is coming back. I would assume still some portion of the buying and selling behavior is mostly due to the overweight and underweight exposure compared to the index. Therefore, some adjusting factor also would play a bit in terms of
So have
momentum.
you in your funds also made a tactical shift on where you're underweight, overweight, etc. right now?
Yeah, we constantly review this.
Yeah.
In fact, the only way you can actually, as a money manager, especially at the time when the market is becoming broader and complex, keep closer to your benchmark and then see where you're overended. Definitely, auto is one as part of our consideration in terms of either become neutral weight or a little overweight. Given the fact the sector can perform a little better, purely on the basis of 2-3 things which I just mentioned about earlier.
Sure.
Plus, also we are
Reduced
ahead
IT?
of the monsoon, a good monsoon leading to a good revival in the rural economy.
Sure.
Therefore, things will pick up.
Reduced IT, added FMCG.
I think IT will always be a neutral weight.
Sure.
Maybe the marginal underweight could be there.
Sure.
And the metal is the one where we were as a fund house had a good run in metal sectors, owning some of the stocks both in aluminum and steel, and some I think got reduced, and therefore that got shifted to auto sectors to some extent.
Okay, I'm just going to mark one stock here, that's Delivery 671. Now this is one of the stock from the internet space which has done exceedingly well. The management here is conscious about profit. Every time we've interacted with the management of Delivery, they've said one thing: we are not burning money and we are profitable. We know what the path of profitability is because that's a basic requirement by fund managers and the markets. But what I want to discuss with Bala here as capacity of the AMFI chair and CEO of Aditya Birla AMC is the SIP number. That data will just come up on your screen, that how in this market fall, if at all, SIP culture has only solidified more. The data point which captures the SIP data point of April, May, June will just come up on your screen. And Bala, trust me, I just feel so happy when I see this. I just feel so happy. Do you see it changing? Because in last 1 year, markets have not given any returns.
Correct.
And if you've come after COVID, you've made money. And suddenly last 1 year, you've not made money. And even though mutual fund document says that past performance is no guarantee of future returns, but that has been used as a benchmark.
Correct.
Do you see SIP culture getting challenged because of recent underperformance?
Not really, actually. On the contrary, I think since the time the volatility got set in, sometime the last almost 1.5 to 2 years, and then there was a bit of slowdown in terms of flows in the beginning of the pandemic period, and post that got revived. In fact, the run rate, of course, keeps changing. When I mean the run rate per month used to be somewhere in the range of about 8,000, 8,500 crores, and now it's crossed about 9,000 crores size. Today now come to the range of about 11 to 12,000 crores size. And then the kind of new investors who are coming in through the SIP also have been rising. The last, of course, is the last 1.5 years, the number of people who tried their luck by investing in equity market directly had gone up quite significantly, which was reflecting through the number of accounts, demat account got opened
That
up.
data will also come up.
And
The
in
demats have come down.
fact, the last, the fall that we witnessed, I think post this Ukraine war, the kind of money which people would have lost have made them realize investing through the mutual fund, through the SIP, when I have to build my longer term portfolio, that's the best way to actually construct the portfolio rather than going and taking a bet in the equity market directly
But Bala,
and burning my fingers.
Mahesh comes and says that we should be Atmanirbhar. Isn't this India becoming Atmanirbhar when they are not going to mutual funds? What's wrong in it? We all are becoming Atmanirbhar.
There is no question on that, but I think the culture, of course, is changing. Equity culture is coming in. People are willing to take a risk on equity. And that's something which is good change that is coming in. At the end of the day, the risk appetite, if it goes up, naturally, you'll find
That's
the
a demand
mutual
growth.
fund. Yes.
That's the demand growth. It's come down from 3.4 million accounts in the month of Jan to 1.8. These are fresh additions, Bala. They've almost come down by 50%.
Exactly.
And SIPs have gone higher.
Exactly.
This is the only place
So the answer is
Atmanirbhar
in
may
front
not
of you
apply.
then.
No, but Aisha,
People don't want to be Atmanirbhar.
well, Mahesh's favorite theme is that I like PLI schemes and Atmanirbhar Bharat. So I'm just wondering that when it comes to mutual fund, why not apply it?
No, that's why we actually as an industry have been promoting mutual funds at all point of time. It's only for this simple reason that ultimately if one wants to actually fulfill the longer term goal needs of any purpose that they have, only through the SIP they can fulfill it. Secondly, the market will go through ups and downs, there is no question on that. At the same time, the longer term outlook on equity, as long as they are able to deliver return in nominal GDP plus 1 or 2% higher, I think it's substantially is more than enough to compensate for any kind of uncertainty that individual investors will go through in the market.
That's the point. Sometimes we think that equity is an asset class, Aisha. Depending on what your need is, you have to approach it differently. For a trader, he does not have the luxury of 3 years. And for an investor, you have to have a 3 to 5 year time frame in order to create wealth. One classic example.
And for a SIP investor, even more, you have to stay the course.
Exactly. And
Yeah.
that's what I think the important differentiation is. So trading is different, investing is different, and wealth planning is different. If you mix all three of them and put everything in one bucket, then it's a khichdi.
Yeah.
Then it's a khichdi, and that's khichdi in a sense should be avoided. And I'm so glad we're having this chat. Bala, I've known you for over 2 decades now. There are two things which have not changed. Every time I meet you, it doesn't matter bull market, bear market, you got a smile on your face. I like that. But second is that you're always bullish. Is this the reason why? Is this the most important factor for an equity investor in a country like India? Be bullish. Doesn't matter whether it's a war or what is happening in America, what is happening in inflation. If you stay the course in an equity market like India,
Correct.
you will be rewarded. You may not become like a multi-millionaire.
Correct.
You may not become a billionaire, but you will be able to live a peaceful life where you're able to beat inflation. That is the purpose of mutual funds, right?
Exactly. See, first and foremost, for investment world, optimism is a must. Whether
So I'm
you
of an
like
optimist.
Yeah, you have to be a born optimist, and the 5 factor has to be quite high. At the same time, you need to have a conviction that you are investing money for longer term, not investing money for short term. See, if that's the conviction, if one brings in on table, and mutual funds is the best vehicle actually for one to put their savings for longer term savings. At the same time, I think where the biggest mistakes are made is one, you exit when the market turns extremely volatile, and that's the time actually you move out and then try to time the market. And you try to time the market, you never actually get your timing right. Second is that when you start chasing the return. So I think sometimes we do well, sometimes we don't do well. Then we start forming an opinion that this stock is not doing well, this fund is not doing well. As a result of that, if you start moving in and out, there is high probability rupee cost averaging, of course, it completely goes away. Yeah. Second is SIP is not something is on the basis of the return. SIP is based on the agnostic to the market, agnostic to the fund managers, agnostic even fund house, I would say. So therefore, it's agnostic to everything. Therefore, the SIP is something, it doesn't actually allow you to chase the return. It's more of discipline that actually makes it the money. So that's something which is there. The longer term, I think I mentioned about why I'm always bullish, because I've seen market cycles for last almost 32 years from 1990 till date. Despite going through all the ups and downs, the market always finds its higher level after every 2-3 years. It finds its higher bottom, it finds a higher level after every 2-3 years. It's not a rocket science, it simply is it's a computation of the nominal GDP compounding factor is one which actually makes it work. Second, every company, even if it grows at about 11 to 12% or 13%, believe me, the 11-12% compounding if you have to take, then naturally one day or other it has to reflect on the stock price as well as the index. It's as simple as that.
HDFC Bank compounding is 25% in last 20 years and it's 100x. Power of compounding, power of compounding, power of compounding. Please follow it. I'll say it again. I've learned it late in my 30s. I'm trying to apply in my 40s. But for those who are in the 20s, please start applying it. And trust me, life would be very different when you will reach my and Bala's age. I'm not getting to Aisha's age. That's bad manners on television to talk to a lady about her age. So Bala, just one more final question from my side. NFOs have dried up completely. No mutual fund is coming with NFOs, and that was a large vehicle through which money was coming into mutual funds. Do you see NFOs coming back now?
Yeah, NFOs of course coming back. I think NFOs will come only from those fund houses who have a lot of opportunity come with their open-ended funds.
Are you coming with one?
And we may have one where we see some opportunities in our own fund bucket of product that we have, wherever there is a gap, of course we will come with some NFOs. But otherwise, I think industry as a whole, wherever there is a gap, I think you'll see the NFOs coming back. As the NFOs coming back, you'll find again money coming back to the mutual funds more than what you have seen in the first quarter. And even SIP as the flows will also start coming in, little higher amount coming through the NFOs as well. I think NFO is something which brings in both lump sum as well as the SIPs. I would probably see that trend changing in the coming months.
Bala, just one question, and we don't have too much time. Last 2.5 years, you knew that you had to be concentrated in equities. Fixed income was not making you money. Is that changing now? Do you now need to diversify back to fixed income too? A little bit.
Definitely, yes. That's why I mentioned about earnings yields versus the bond yields. I think for any parameter, if you look at it today, and from asset allocation point of view, as from investors' point of view, I think the recent steps taken by Government of India, especially Reserve Bank of India, has made the 10-year bond yields now close to about 7.5%, almost 1.5%, 1% or 1.2% rise in yields. Cannot be ignored from asset allocation point of view. Second is, just about 3 years back, fixed income was one of the most favorite investment vehicle for every investors. The last 2 years, the pandemic brought down the interest rate so much, suddenly people are finding it attractive to invest in equity.
Yeah.
But that now undergoing a change. Definitely, even we are trying to revive some of our open-ended debt funds where investors can put money for a 3-year period. And that's something we are trying to revive it today, like such as dynamic bond fund, medium-term plan. All such fund we are now trying to revive it. Second, also what has happened is the FMP as an asset class died down quite significantly because rates are not attractive enough for people to park their money for 3 years or 5 years. And today the target maturity fund, the form of open-ended nature, also now beginning to rise. We rise close to about 10,000 crores in the last few months by way of launching target maturity fund for 3 and 5 year period. Such kind of fund also provide an opportunity for investors. Only for the simple factor today, Government of India bond for 5 years and 10 years is close to about 7 to 7.5%, and corporate bonds for 5 years about 7.5%. And this kind of yields, even adjusted for earnings, pretty attractive for investors to park their money.
Yeah.
Therefore, asset allocation, in the overall asset allocation, the way people are considering equity and ETF, even the bond portfolios also should be part of the consideration.
Sure, and now is the right time. Bala, always a pleasure having you on the show. Thank you so much for taking the time out.
Thank you. It's my pleasure.
Thank you.